Be an alligator when it comes to investing. This is the famous analogy that I got from Marin Katusa, and it is probably not original with him. And so I'm going to just read to you a part of the article here. This is something that I used to cover when I ran a speculative investment newsletter. And I still do believe in speculating and speculative investments. So we have to be clear about what we're doing. Speculating is not the same as investing necessarily. It's not the same as saving necessarily. And I think one of the biggest problems is people will confuse speculating with investing or saving. So they put money into a retirement account and say, I'm saving for retirement. No, that's not a savings vehicle. Or they say, I'm investing. Well, how much cash flow is that giving you? It's not an investment, it's speculating, which means buying an asset hoping it's going to go up in value so you can sell it later at a higher price. And this is one of the reasons why many people are nervous about retirement, even though they may have significant amounts of money in a vehicle like a 401k. But there is a place for speculative investments, I think, in your portfolio if you have the right psychology for it. And it can be very effective if you do it properly. So, what does the alligator do? Let's go into this. I'll start here. One huge thing that alligators had and continue to have in their favor is their brilliant and efficient hunting strategy. Alligators are ambush predators as opposed to pursuit predators. They don't spend their days chasing gazelles or monkeys. They don't expend lots of energy sprinting after their prey. Instead, alligators take a patient, sit and wait approach to hunting. They spend long periods of time doing nothing but waiting in the water for the perfect time to strike at obvious opportunities. When unsuspecting prey approaches the water, alligators spring forward with awesome speed and force. The alligator's ambush hunting strategy is very efficient. It allows the alligator to get huge returns on the energy he invests in hunts. It has helped the alligator become one of the most resilient, successful species in the history of the planet. I know you don't read Katusa research for nature lessons. I'm telling you all this because I believe the way of the alligator is one of the great secrets for achieving investment success. The counterintuitive way to make big money by alligator investing. When we were kids, we're taught that if we work hard enough at anything, we'll achieve success. More hard work in the gym means performing better at sports. Working hard on your studies means getting into the right schools. Working long hours means getting ahead in business. Working hard has its rewards. It's a great way to get what you want in life. But hard work and its corollary, staying busy, actually works against investors. Staying busy typically translates into losing money instead of making money. Most people who have earned enough money to invest have the natural urge to do something and stay busy. That's how we got the money in the first place. But unless you're a skilled, lightning fast day trader, the market does not reward frequent activity. In fact, it penalizes it. The urge to do something leads you to be impatient and less selective with your investments. It forces you into mediocre opportunities. Said another way, the quality of your investments typically moves inversely to the quantity of your investments. Let me pause here and say, yeah, that's against the standard of diversification, isn't it? They tell you you need to diversify. Warren Buffett doesn't believe in diversification. He's arguably the best investor of all time. He calls diversification diversification. It's like betting on every single horse in the race. You should instead invest in what you know. Invest in what you know. Marin Katusa didn't invest in every sector in the market. He only invested in what he knew, which was natural resource stocks. He started, I think, with a lot of gold and silver. He predicted the uranium bull market. He's made money in the natural resource and energy sector, and that's all he invests in because that's what he knows. He's not diversifying. He doesn't have a mutual fund that diversifies him across the whole broad sector of the market and acts like that's somehow a good thing. That's like betting on every horse in the market. Okay, let's continue quoting Marin Katusa. For investors who look to hold positions for months and years, the market simply does not serve up truly great opportunities every day. Sometimes we only get two or three per year. Just like doing nothing and waiting for a great opportunity is often the right move for an alligator, it's also often the right move for investors. To many investors, having a large cash balance in an investment account feels like having a wad of cash in a casino. Why let it sit there and do nothing when you can play with the money? Why not at least take a shot at something? This amateur thinking is why casinos earn billions of dollars in profit at the expense of impatient, probability ignorant gamblers. Doing nothing, staying patient, and waiting for a no brainer opportunity is often the right move. Okay, now let me insert my commentary. This is where whole life insurance comes in. Instead of continually dollar cost averaging into speculative investments in the market, you could instead save your money. Just keep it safe in whole life insurance. Why is this important? Because if your money is in whole life insurance, it's not doing nothing, it's working for you. Your money in whole life insurance is earning a competitive rate of return competitive with a savings account. So, over the long run, 4 to 6%, tax free with no market risk. It's protecting you with that permanent death benefit. So, you have a guaranteed result that plan will succeed. Your death benefit will pay out. It's protecting you against long-term care needs. There's creditor protection. There might be critical illness protection. Plus, when you use the money in your policy keeps earning for you. So if you build cash value inside of a whole life insurance policy, and then a nice opportunity comes along, you can take out a policy loan and go and make that investment. Meanwhile, the money in your policy keeps earning for you. So you're earning in the investment and you're still earning on that same cash in your whole life insurance policy. So conceptually, you're earning in the investment and you're earning as the bank that financed the purchase of that investment. So whole life insurance helps you to stay disciplined and do what the Warren Buffetts and the Marin Katusas do. They're not dollar cost averaging. They're not investing every day. Like Warren Buffett says, being a good investor means saying no 99% of the time. Having whole life insurance helps you to have that discipline because you don't feel like my money is doing nothing. It's not working for me. Yes, it is. Your cash value is going up all the time, contractually guaranteed. So you don't need to take on risk in the market to have your money working for you. It is. So then you'll be much more disciplined about knowing when a real investment comes along when you can make serious money. And here I'm talking about speculative investments. I'm not talking about real investments that cash flow like real estate or businesses, where you could almost, in theory, start those at any point in time and over the long run do very well. With speculative investments, timing is much more important. And that's why you have to be disciplined and patient by letting your money safely earn for you in your whole life insurance policy and having the patience to wait and do nothing until a great investment comes along. So sitting on the sideline and doing nothing is more difficult than it sounds like. But that's what good investors do, like Marin Katusa and Warren Buffett. Okay, let's continue. Alligator investing, a real world example. When I first published an investment idea I had on a junior gold and copper explorer, I told subscribers to be patient, like an alligator. The company announced some news that investors bought hand over fist. They were chasing the stock. I had a certain price I wanted to scoop up shares, and I would wait on the sidelines to do so. Once the shares hit my target, I pounced like an alligator. Here's what happened. And here you can see the chart of Sun Metals, which they waited for it to fall from almost 30 cents to 22 cents a share, this is Canadian dollars. In late December of 2018, they bought it under 22 cents a share. And then by March or late February of 2019, it has gone up to 61 cents, nearly a triple. That's a 277% gain in basically 3 months, one quarter. Pretty darn good. Then Marin Katusa continues. Many investors aren't patient enough for the strategy, but one of the most famous alligator investors has used it to make billions. The ultimate alligator investor, Warren Buffett, on waiting for the fat pitch. The investment legend Warren Buffett makes a great point about patience with a simple baseball analogy. Buffett says investing is like playing a baseball game where there are no called strikes. You don't get penalized for not swinging. You can stand at the plate for a year and not have to swing. So it makes a lot of sense to stay patient and selective and only swing at fat pitches. You only need to swing when the odds are overwhelmingly stacked in your favor. One of your ultimate goals as an investor is to buy assets for less than they are really worth. Said another way, your goal is to buy bargains. However, true bargains are rare. The financial market correctly prices most assets most of the time. Most of the time, stocks, bonds, and commodities trade for approximately what they are worth. But every so often, there is a crisis in some market somewhere in the world. During a crisis, investor emotion overwhelms investor reason. Terrified investors sell first and ask questions later. They sell assets with no regard for their underlying value or ability to produce cash flow. I often say that during crashes, the price of assets become unhinged from the value of assets. Now, let me pause and insert my commentary here. It's actually more than what he's saying here. It is true that some investors just sell based on emotion because they see the market crash, they get scared, and they sell. But it's also true there are lots of investors who sell when they don't want to. There are investors who know that they should be holding for the long run. Now, I'm not a huge fan of that strategy for many reasons. I would say instead of holding, why don't you just keep putting money in your whole life insurance policy, patiently building cash, and only buy when the market crashes? Because we know the market's going to crash about once every 10 years, is what happens. We know it's going to crash. The best returns in the market are in the years after a crash. So it's very disingenuous when they talk about averages in the market. Those averages of what the market earns is inflated by the massive returns you see in the wake of a crash. But if you had your money in the market before the crash, those massive gains you get after the crash only get you back to where you started. You're not really seeing a net gain. It takes 2 or 3 years for the market to recover. And so you see 2 or 3 years of very high gains percentage wise, but you're not benefiting if you were invested before the crash. You're just recovering. The people who truly benefit from those massive gains are people like Warren Buffett, who are sitting on the sidelines with cash. And then when COVID happens, when the 2008 financial crash happens, he comes in and scoops up these assets on the cheap. But if you're invested all the time, you cannot do that. You have to be on the sidelines with cash to do that. The other point that I'll make is that a lot of people who sell because they're forced to. There were people during COVID and during the 2008 financial crash who were trying to hold for the long run. They didn't want to sell. They knew it was a bad idea, but they didn't have a choice. When there are these market crashes, that is when you're most likely to be vulnerable financially, meaning you lost your job, you got laid off, you have no income, right? You've worked your way through your savings and now you have no choice and you hate doing it, but you have no choice but to sell good assets on the cheap at a loss because you have to live. You have to spend money to live. That's why it's so important to have a buffer of cash in whole life insurance so that if and when that does happen, you can weather the storm if you're invested. Or if you're not invested, you can come in and scoop up assets all the cheap by using policy loans from your whole life insurance policy. But you've got to have that savings, that safe foundation first before you can safely invest. Otherwise, you'll get shaken out of the market during the bad times, even if you don't want to be. It might not be your emotions. You might be disciplined enough emotionally to see this is a crash. We all know it's temporary. The market's going to recover in 3 to 4 years. Okay, but if you lost your job, you have no income and you have no savings, what are you going to do? You have no choice but to sell those assets. So what we say is during the bad times, what happens is assets pass from weak hands to strong hands. Assets pass from weak hands to strong hands. So people might be holding a good asset, but if they're weak, meaning they don't have solid savings and a foundation, then what happens is they get shaken out of those positions against their will. They don't want to sell, but they sell when they don't have a choice. And then the strong hands, like the Warren Buffetts, come in and buy them up because they have the cash, they have the savings, they have that buffer, they have large whole life insurance policies just sitting on the sidelines, safely earning waiting for a crash like this. So investors might not be selling based on emotion. They might be selling because they have no choice. Okay, let's continue. Marin Katusa continues. If you're impatient and you're always doing something, you won't have the cash to buy up bargains during a crash. It's the financial equivalent of not bringing your helmet if you were to play in the Super Bowl. I like to put my money to work as much as anyone. I love the game of investing, but I always keep the way of the alligator in mind. I see my cash as big returns in waiting. And then I'll skip a bit and says, the alligator, he's nature's ultimate patient opportunist. By staying patient and only acting when the odds are overwhelmingly in your favor, you'll survive and thrive in the investment world. So ends Marin Katusa's little article. And I just want to point out again, this is the opposite of the typical investment advice, which, in my opinion, is fairly self serving from Wall Street's perspective. Why do they tell you to dollar cost average? Why do they want you to automate your $3,000 contribution to your brokerage account, your IRA, every single month? So many people just turn their brains off because they don't want to deal with their finances. It's just a headache. And so Mr. Financial Advisor comes along and says, hey, give me $500 a month, $1,000 a month, $3,000 a month, whatever the number is, it doesn't matter. Give that to him. And then you feel like, whew, that headache is gone. That's great. Now I got my money working for me and I don't have to worry about it. Well, it's still your money. You still got to take responsibility for it, don't you? Do you hear about people who say I got rich because I handed a certain amount of money over to my financial advisor and he did all the work? That's not what Marin Katusa did. That's not what Warren Buffett did. So it's the four rules of financial institutions. Rule one, give us your money. Rule two, give it to us on an ongoing, systematic basis. Rule three, let us keep it for as long as possible. And rule four, if and when we give it back to you, we're going to give it back to you as slowly as possible. So when you think about the logic of dollar cost averaging, what they're really doing is just making sure that they can receive your money regularly. So regularly you have cash flow leaving your personal economy going to Wall Street, as opposed to when you pay premiums into a whole life insurance policy. When you first start doing it, it feels the same. It feels like I've got money leaving my economy. It feels like this is a cost, just like it's an insurance policy, which it is technically. But over time, you realize, no, what's happening is I'm actually recapturing that capital inside my own private banking system where I have control over it. I can take out a policy loan anytime I want, contractually guaranteed. It's my money, it's liquid. It is earning at a safe, guaranteed rate. So I'm not worried about what the market is doing. And if I want to put my money in the market, it's not an either or scenario. Of course, you can do both. You can do both. But I think the more you start stacking up your savings, not investing, savings in your whole life insurance policy, the more you start to look askance in the market and say, I could do that. I could go for mutual funds and index funds and all that. I could do that and get potentially a higher return, hypothetically. Or I could just keep safely earning in my whole life insurance policy without the risk, without the headache. And people start to appreciate then the psychological benefits of just keeping the money safely earning. And they say, I could, but nah, why? And so then what happens is they start to recognize what a real investment looks like. And so then they just keep safely earning in their whole life insurance policy and they only deploy their capital when a real investment is coming along, whether it be a really good speculative investment like Marin Katusa is talking about, where you're shooting for 1,000% gains. You're buying deals that are ridiculous. Or you're putting it into a real investment, meaning an investment that cash flows, like starting a business that's going to generate income for you, like investing in real estate that's going to cash flow. It's all about generating cash flow, it's all about generating income. So when you think about those four rules of financial institutions that I just outlined, you can think about how your standard financial advisor will advise you and how it oftentimes fits in very well with those four rules of financial institutions, where really the only strategy, if it can be called that, is about how and when and how much money are you going to transfer from yourself to Wall Street on a regular basis? That's really the only strategizing that goes on. And all of their frameworks are really just sales and marketing material for Wall Street that really just catalogs the products that they have. That's really all they're doing. But it all rests on the same unstated premise that the only way to accumulate capital is to give up control of your capital to somebody else. Or even if you're doing it yourself, you're giving up control of the outcome because you cannot force a stock to appreciate in value. You have to just wait and hope that it does. Um, and then just hope that the value of those assets goes up. As one person puts it, that's an accumulation strategy. Maybe it does work in the sense that you can accumulate some amount of value in the stock market. But then the real question becomes, so what about distribution? Those assets don't really help me until I use them to generate income, which again, it can work if you sell them for a gain. Sure, it can work. I'm speaking with someone right now who's thinking about retiring relatively early. And this person does not earn a lot of money, nor do they have a lot of money saved. But you know what they do have? A pension. A pension. This person is a widow. Unfortunately, her husband died. She still has her husband's pension until the day she dies. She's working. When she retires, she will receive a pension. So she's actually fairly close to being able to retire because she has a guaranteed lifelong income stream between her husband's pension and her pension when she retires. That is, I think, a better way to think about retirement, or let's call it financial independence. It's not so much about building up a nest egg, although nice to have one. It's more about generating income. How much income can you generate? Your most valuable asset is your ability to generate income. That's your most valuable asset. And so during your working years, you're going to be actively earning income, running your business, working your full time job. And then what you want to do is take the active income that you earn and put it into real assets that generate cash flow until you can generate enough passive income, passive being a relative term, nothing's 100% passive, but passive income to the point that you can live off of the passive income. And at that point, you become financially free. That's when retirement becomes a reality because now you can safely live off of the passive income from your investments. And then what you decide to do is up to you. Maybe you keep working. Maybe you work a lot less in a job that you really enjoy that doesn't make a lot of money, whatever. At that point, it's totally up to you. Retirement can mean whatever you want it to mean. I use that word because I think people are used to hearing it, but I prefer to talk about financial independence, financial freedom. That's what we really want, which doesn't necessarily mean being rich or wealthy, but being financially free, being financially independent. So I hope this was helpful in terms of talking about the psychology of investing, the psychology of money, and how the things we've been programmed to do are not what the sophisticated, intelligent investors are doing. And by the way, you don't have to be an investor to get rich. You don't have to take on risk to get rich. There are plenty of millionaire next door types who just got rich because they saved money. And maybe they were saving their money inside of a retirement account or mutual funds or what have you. But what made them rich wasn't the return they got on their mutual funds. What made them rich is the habit of being a disciplined saver every day. And if you're just a disciplined saver and you just save your money in something like a whole life insurance policy or just a savings account or wherever you put it somewhere safe, you can become financially independent over time. But it's more about the income you can generate. So if you do have a nest egg, if you have accumulated a large amount of wealth, that's good. That's good. Now let's talk about strategies to maximize the income that you can get from that asset. So I hope this was helpful. We'll talk soon.